Good Sunday, everybody. It is yet again Sunday, and today again is Sunday, and it's time for another episode of the David Hittle Real Estate Show. I am your host, as always. I am David Hittle, Realtor with United Real Estate Louisville. And today we are going to talk about the best way to approach or to deal with um, the higher mortgage interest rates that we are seeing um, in today's housing market from the buyer's perspective, because the buyer's uh, perspective on mortgage interest rates is what is important. Sorry, little last minute getting prepared there. If you haven't already, please visit my website, www.shopkentuckyhomes.com. On that website, um, you'll be able to take in what is happening in this mortgage world and in this real estate world. I do weekly updates, blog updates that are on my website, as well as finding out the value of your current home. Um, you can also find your next home all on my website. So please visit my website, shopkentuckyhomes.com, for all of your real estate needs. So, the big question, how to approach these rising interest rates, rising mortgage rates as a buyer. So, in the last few weeks, heard, if you haven't heard by now, mortgage interest rates have topped 5%, and that is 5% on the market, which means it's even higher when you go to get a mortgage. But they have now topped 5% this week, hitting last week, hitting 5.11%. And while that news may have you questioning the timing of your home search, the truth is timing has never been more important, because you may feel tempted to put your plans on hold in hopes that rates fall. However, waiting will only cost you more, because mortgage rates are forecast to continue to rise in the year ahead. So, what should you do? Well, here is my suggestion as a real estate professional. If you are going to buy a home this year, you need to find that home now, get with your lender, get the rate locked now, and be prepared to move in when the time comes. If you are thinking about buying a home, um, you don't really know, you're not really prepared, you're not all that interested, then you might want to just hang on, because rates are going to go high. Rates are going to go really, really high, which is going to be great for hopefully soon, for your bank savings account. You might get more than a quarter of a point from your bank savings account in the near future, but it's going to be horrible for things like your mortgage. If you're not on a fixed rate mortgage, it's going to be bad. Things like your credit card interest rates, those are going to go up as well. Car loan interest rates, if you haven't bought a car, your rate is not locked in on your car. Car interest rates are going to go up. All of this is being fueled by the Federal Reserve. So the Federal Reserve is sort of like America's central bank. They are the ones that determine certain interest rates for America's debt. So the Federal Reserve raises and lowers interest rates on things like government bonds and treasury notes, things that are internal to the country. So when they decide that they are going to raise interest rates, which they have decided now, they plan to raise interest rates in an effort to stave off inflation. Raising rates is going to help with inflation, they believe, anyway. And so, in doing so, raising rates raises the interest rates, not apples for apples, but in the long term raises the rates for mortgages and raises the rates for all sorts of other type of debt as well. So the Federal Reserve in March raised the interest rates that they control by a quarter of a percent, 0.25. And since that time, mortgage interest rates have gone up over 1%, maybe around 1.5 at this point, since that quarter point change. Now, the Federal Reserve has indicated that they may want to raise this next round, which should be sometime in May, by half a point or 0.50. Some are speculating they may even go for 0.75. If this occurs, ultimately, mortgage interest rates will skyrocket as well. I am predicting if this continues and the Federal Reserve continues to want to raise rates throughout this year, you may see 6, 7, 8, 9% interest rates. That would not be fun for anyone that doesn't have a locked in mortgage. For those who own a home, you are completely safe as long as you have a fixed rate mortgage. If you took advantage of the low rates and refinanced to a lower rate, as long as you refinanced into a fixed rate mortgage, you're perfectly fine. If you are in a adjustable rate mortgage on your home, then you're in bad shape. You need to get that refinanced to a fixed rate mortgage because um, in your next round of increases on your mortgage, you're going to see a dramatic rise. So you're safe if you own your home and you have a fixed rate mortgage. Not so safe if you have an adjustable rate mortgage. Those are bad. You shouldn't have those anyway. Um, but uh, this is the housing market that we find ourselves. So, how the rising mortgage rates impact you. So, looking at the mortgage chart, just principal and interest on the monthly. And the lowest it goes is $360,000. So we'll go with that. $360,000 home loan at 4.75% is $1,878 a month. That's principal and interest only. As the rate rises to 5.25, which we are now over, your mortgage payment rises from 1878 to 1988. When it rises to 5.75, you go from the 1878 to the 1988 to 2101 a month. and at 6%, you're at 2158. Now, I haven't spoken to my lender recently about what the current rates are, but I would suggest that with us being, with the average being at 5.11, a really good credited individual might be able to find a 5.5% loan today. So, mortgage rates are on the rise. You've likely seen your purchasing power impacted. That's what it impacts the most because with your rate going up, your monthly payment has gone up as well. So, what you can do to counteract that is that you have to reduce the maximum amount of your loan in order to still have the monthly payment that you want. Instead of delaying your plans, today's rates should motivate you even more to purchase now before rates increase anymore. And you should use that motivation to energize your search and plan your next steps accordingly because rates are not going to go down. It's not going to be like last year. Last year was fun. Last year was nice. This year, mortgage interest rates are on the rise. Home prices are going to continue to be on the rise. And getting into your home now rather than waiting is your best bet. Also, the best way to prepare is to work with a trusted real estate advisor now. I, an agent, can connect you with a trusted lender and help you adjust your search based on your budget and make sure you are ready to act quickly when it's time to make that offer. So, again, serious buyers should approach the rising rates as a motivating factor to buy sooner, not a reason to wait. Waiting will cost you more in the long run. So, we should connect today so you can better understand your budget and so that you can be prepared to buy your home even as rates climb further. Amazing, isn't it? Now, there's also a lot of talk out there about a bubble, a housing bubble. And even the government has speculated that there may be a housing bubble or a housing crash. Well, the only reason there could possibly be a housing crash is if the government is increasing interest rates on purpose and really messing with people. But I don't think that is the case, and the experts don't either. But we have to be aware of everything. So if you are interested in anything real estate related, you can visit my website, shopkentuckyhomes.com. On that website, again, you can look at my weekly blogs, stay informed on what is happening in the real estate market, and you can also reach out to me if you have any questions or a real estate need. So, why this housing market is not a bubble that is ready to pop? So, home ownership, of course, is a major element in achieving the American dream. The National Association of Realtors found that 86% of buyers agree home ownership is still the American dream. Prior to the 1950s, less than half of the country owned their own home. And then after World War II, many returning veterans used the benefits that they had received from the GI Bill to purchase a home. And since then, the percentage of homeowners throughout the country has increased to the current rate today of 65.5%. And that strong desire for home ownership has kept home values appreciating ever since the end of World War II. So they give me this fun chart, and it starts in 1945 and goes all the way up to 2006. So from 1945 until 2006, home prices have been rising. Home values have been rising. home homes have cost more. Uh, After 2006, there was a dip, and then that dip has already been obliterated by the rises in home appreciation since then. Of course, 2006 was the housing bubble that finally burst due to many other things in the market. So, what caused the housing crash 15 years ago? So, back in 2006, foreclosures flooded the market. That drove home values down dramatically. The main two reasons for the flood of foreclosures were many purchasers were not truly qualified for the mortgage that they had obtained, which led to more homes turning into foreclosures. A number of homeowners cashed in the equity on their homes when the prices dropped. They found themselves in an underwater situation where the homes were worth less than the mortgage on their house. Many of these homeowners walked away from their homes, leading to even more foreclosures. And this lowered neighboring home values even more. The cycle continued for years. However, this time around, in this possible bubble, it is different. The government stepped in during the coronavirus pandemic in order to prevent a lot of foreclosures, and prevent they did. A lot of foreclosures that could have happened or would have happened if the government hadn't intervened did not happen because of the intervention. And because of that intervention, people went on to go ahead and pay their loan off. They kept paying even though they didn't have to, et cetera, et cetera. Today, demand for home ownership is real. It's not artificial. Running up to 2006, the banks were creating artificial demand by lowering the lending standards and making it easy for just about anybody to qualify for a home loan or refinance their current home. Today, and since then, purchasers and those refinancing a home must higher standards from mortgage companies. The data from Urban Institute shows the amount of risk banks were willing to take on mortgages back then compared to today. Back then, there was a lot of risk going on. If you wanted a loan, the bank would probably give you one. And the banks thought they were too big to fail and that the government would guarantee and that the government would back all the bad things that the banks were doing. And so they had a lot of risk. Today, it is the borrower that has a lot more risk. You have private mortgage insurance that protects the bank in the event that you do get foreclosed on. You have higher interest rates that prevent a lot of people from having higher mortgages than they can afford. You have higher debt to income ratios that lenders are under that prevent them from giving you a loan if you have a lot of debt. There's always risk when a bank loans out money. However, lending up to the housing crash 15 years ago, lending institutions took on much greater risk in both the person and the mortgage product offered, and that led to the massive defaults and foreclosures and falling prices. Today, the demand for homeownership is real. It's generated by a re evaluation of the importance of home due to the worldwide pandemic. Additionally, lending standards are much stricter in the current lending environment. Purchasers can't afford the mortgage they're taking on, so there's little concern about possible defaults. And if you are worried about the number of people still in foreclosure, you should know there's no risk of that causing an upheaval in the housing market today. There won't be a flood of foreclosures. Another difference is that people are not using their homes like ATMs like they did in the early 2000s. As I mentioned previously, when prices rapidly escalated in the early 2000s, many thought it would never end. They started to borrow against the equity in their home to finance new cars, boats, and vacations. That's why you should never take on additional debt for dumb things. When prices started to fall, many of these homeowners were underwater. They owed more than their home was even worth, leading some to abandon the homes altogether, and this increased the number of foreclosures. Homeowners didn't forget the lessons of the crash as prices skyrocketed over the last few years. And Black Knight, a equity reporting service, reported that the tappable, what you could do, the tappable equity or the amount of equity available for homeowners to access before hitting a 80% maximum has more than doubled compared to 2006, from 4.6 trillion to 9.9 trillion. And the latest Home Equity Insight report from CoreLogic revealed that the average homeowner gained $55,300 in home equity over the past year alone. Amazing. So, the bottom line in all of that is the major reason for the housing crash 15 years ago was a tsunami of foreclosures. Today, with much stricter mortgage standards and a historic level of homeowner equity, the fear of massive foreclosures impacting today's market is just not realistic. So, if you are wanting to purchase a home, now is the time to do so before the rates rise any further. And if you are a homeowner and you are wanting to sell and move, that is perfectly okay. You can do that. You can get your rate locked in on your next home and have the peace of mind of knowing that you're getting the best rates that you can today. So before I finish up here with the last article that I wanted to talk about today, I did want to invite you to my website, shopkentuckyhomes.com. Again, on that website, you can get your current home's value. You can get market reports for your neighborhood, for your zip code. You can find out what is happening in today's real estate market. And whether you're looking to buy or sell a home or not do anything, it is important to know what is happening in today's real estate market so that you have an upper hand on the fear. So you're not scared, hiding away um, in a closet uh, because somebody said, oh gosh, the whole world's coming to an end. Being up to date, knowing what is happening, puts you above all the scare tactics. So, myths about today's housing market. I thought this would be interesting. Myths. So, here are a few misconceptions about today's competitive real estate market. Buyer myth. I should wait to buy a home until home prices and mortgage rates fall. The reality is, experts say prices and rates will continue to rise this year, and waiting means that it will cost you more in the long run for your home. A seller myth is I can set the asking price for my home at whatever I want. Reality is, you can't pick just any price. Pricing your house appropriately for the market takes expertise a real estate professional can help. Buyer myth, waiving the home inspection is a great idea if I want my offer to stand out. Reality is, an inspection tells you the condition of the home and can help prevent unpleasant surprises. Waiving it could cost you a lot of money. Seller myth: I have to renovate my house before selling it. Reality is, you should partner with a real estate professional for expert advice on what you need to tackle, because some renovations may not be worth it in today's market. So let's connect so you have an expert to help separate fact from fiction in today's housing market. So, everyone, I thank you all for spending your Sunday here with me. It is Pigs in a Blanket Day. So, if you enjoy pigs in a blanket, make sure you go and get some of those very tasty pigs in a blanket. And until next Sunday, it will be May. It will be May. Actually, it'll be the very first day of May next week. Until then, I hope to uh, continue to educate, continue to inspire, continue to help each and every one of you with all of your real estate needs. Thank you all for tuning in and have a great day.